Good morning, everybody. It is wonderful to have you with us again. It's our final webinar, IFRS webinar for 2020. And I'm sure that you, like us, would like to see the back of 2020. I'm really counting down the days until the office is closing and we all get some well-deserved rest. As always, I have with me Kevin Frobers, our IFRS advisory partner in Sydney. So good morning, Kevin.
Good morning, Aletta, and welcome to this fine last webinar of the year. Isn't it a good feeling, Aletta?
It is a great feeling. However, Kevin, when I was preparing the slides and thinking about what we'll be covering, I thought, Aletta, why did you schedule this particular topic as the last one for the year? Because it's a big one. It is actually a scary topic. And as you work through it today, you'll see we've got big changes coming our way. And I suppose as we try to work through 2020, we might have taken our eyes off these looming deadlines. And even if you look at the proposed effective dates, that they've always looked very far. But now, if you want to make use of some of the transitional relief, we're actually talking 30 June 2021, which is just 6 months away. So it's a scary topic for a last topic, not the normal upbeat topic at the end of the year, but let's give it a go. All right, so if we look at today's session, and this is why I'm saying it's scary, we look at an end of an era, we look at the end of special purpose financial statements. We also look at the end of reduced disclosure requirements, RDR. We then try and give some good news, and that is transitional relief. So if you volunteer to end special purpose financial statements, and if you volunteer to end RDR by 30 June next year, you get transitional relief. Then continue on the good news, we want to provide a demo of a technology solution to help you with the new disclosures, simplified disclosures, which is replacing the old RDR disclosure. So a very short demo to show you the efficiencies to be gained and the time and effort saved. And then finally, I've got a thought-provoking video on what are the financial implications of getting migration to Australia or employment in Australia wrong. So it starts a bit of doom and gloom, and hopefully there's some good news towards the end. The other thing that I wanted to flag, you can now register for our 2021 IFRS webinars, and I've provided the link to that registration page. But the other thing that we are very excited about, we have a new partner in Perth, and she's also put up her hand to participate in these IFRS webinars. Now, she's been running sessions in Perth. She's got a lot of clients within natural resources, but also not-for-profits, large proprietary companies, and we're very excited for her to join Kevin and I. Hopefully, we can make these webinars even more interesting in 2021 onwards. So we've got a new presenter. So Kevin, I think next year we can take a rest.
That's true, we can, and maybe also introduce some fresh ideas into the thinking for our dedicated attendees.
Absolutely. Just to give you an idea of our webinars, the dates, the first one we kick off just after Australia Day to make sure we're all back. We're looking at changes to the new or the changes to IFRS 3 business combinations. Kevin and I have recently attended global training where we've looked at the practical and commercial applications of this and the accounting policy choices being introduced. So a very interesting one, especially in the current climate where we see so many transactions happening. And then we look at, continuing discussion around transitioning to general purpose, in particular, looking at IFRS 1 or AASB 1, And then Kevin and I are really excited, actually, about the webinars we've scheduled for March and April, where we look at the selection of appropriate accounting policies to reflect your business model, the commercial outcomes, or the best commercial outcomes. So we want to look across all the accounting standards at the basic alternatives, practical expedience, accounting policy choices. So a number of topics scheduled for next year, so please register and we hope you can join us next year. So let's move on to the end of special purpose financial statements. Now, I want to start with the current state. And I know this looks terrible and I want it to look terrible. When I joined, and I think I've told you before, when I immigrated to Australia now nearly 19 years ago, I found it really hard to get my head around which Australian accounting standards would be applicable to which entities and when. And I've really developed this decision tree about 18, 19 years ago and worked on it over the journey, and it always has been a work in process. The one thing I know is that in Australia, we start with the question, or we used to start with the question, now, is this entity that's preparing financial statements a reporting entity as defined in SAC 1? And you have to remember SAC 1 is an Australia-specific standard. So obviously that was my first introduction to that concept. So in SAC 1, if you've decided that this entity is indeed a reporting entity, that would force you down the left-hand side of this diagram that you have to prepare general purpose financial statements. And then a few years ago, there was an introduction of the concept, if the entity has public accountability as defined in AASB 1053, you would distinguish between Tier 1 and Tier 2. Now, if you're in Tier 1, so normally our listed entities, that means recognition, measurement, disclosure, everything under full Australian accounting standards and also IFRSs. So that's a top tier, Tier 1. However, if you were in Tier 2, so you are preparing general purpose financials because you are a reporting entity, but you don't have public accountability, you had a choice to voluntarily go to Tier 1, or you can do Tier 2, which meant all the recognition and measurement of all the Australian accounting standards, but reduced disclosure requirements, RDR. And the way you would have identified what you would have to disclose and what you could leave is you would look at all the accounting standards, and if a specific requirement are grayed out, then that you don't have to do for RDR. So I think this green side, is the easier side. There's a change there as well, but that is at least the easier side, and I think we're all familiar with that. It's this right-hand side, the red side, that has really created issues and still creating issues as we speak today. And that would be a situation where an entity assessed that they're not a reporting entity under SAC 1. Remember, that is a self-assessment. Yes, auditors look at that. Yes, regulators look at that. But initially it's a self-assessment. An entity decides whether they're a reporting entity or not after they've considered everything in SAC 1. And if you go down this route on the right-hand side, you only required to prepare special purpose financial statements. So I'm still following that. However, this is where it gets really murky, and you'll see I've put a lot of question marks and sections in red here, because if you are not a reporting entity, you're preparing special purpose financial statements, but you are a disclosing entity, a public company, a large proprietary company, a registered scheme. And if you look at foreign-owned companies, I've put in there, remember there are new rules around SGEs, then you have to lodge and prepare and lodge audited financials with ASIC. And if these are special purpose financial statements, ASIC has a view that you have to comply with, recognition and measurement of all accounting standards. And they say at least do recognition, measurement, disclosure of all these standards, a short list of standards, but they also want you to do recognition and measurement of all the other standards, and it's in their regulatory guide. And then there's a but there, a very important but, consolidation not required, because at the time, the thinking was that consolidation is not a recognition and measurement standard, but indeed a consolidation standard. So you can see, even in this situation, a lot of red, a lot of question marks. Now, if it's a small proprietary company, more question marks. Which accounting standards do we have to comply with? A lot of question marks. If you're a not-for-profit entity and you're lodging with the ACNC, again, certain standards you have to comply with in full, but what about the rest? What about disclosures? And if you go outside that, if you are preparing financials as a result of a trust deed or legislation, what are the requirements of that legislation, that trust deed? So this whole red area of special purpose has been a big issue. This decision tree continues to evolve. But I wanted to sketch the current status and maybe in a way how problematic it is. Now, overlaying with that is we know that Treasury have made changes to the reporting thresholds. So this is the requirement to prepare and lodge financial statements with ASIC. This is already in place. And this has been put in place to get ready for this move from special purpose to general purpose. And the previous, or I would say the current thresholds, the previous thresholds, you look at consolidated revenue, gross assets, employees, and you make an assessment. If you look at the new thresholds, which we now have for years beginning on or after 1 July 2019, so you would have taken this into account for 30 June 2020, for 31 December 2020 onwards. If you meet two of these criteria, you would be large. So consolidated revenue of 50 million or more, consolidated gross asset of 25 million or more, and if you look at your employees, 100 or more employees. So what we're seeing here is that the need for entities to prepare and lodge financial statements with ASIC, there's been a significant lift in that threshold. And if you're potentially sitting between the old threshold and the new threshold, you no longer have to prepare and lodge these financials with ASIC. And obviously that has requirements for an audit as well. So we know, if you've previously prepared and lodged with ASIC, you would have been audited. Going forward, even though you no longer have to prepare and lodge with ASIC, there's tremendous value in an audit to know that the third set of eyes, independent eyes, are going to look at the financials, look at the controls in place. So definitely, whether you're preparing and lodging with ASIC or not, I don't think should impact your decision around the value and the amazing value created by audit. But this is just, let's focus on the reporting thresholds. First of all, I just wanted to touch on not-for-profit entities as well. Because most of the session today we focused on for-profit entities, but let's just look at the current status for not-for-profit entities so we have a good view of the current landscape. Now, the ACNC requirements links financial reporting to the size of the charity. And you've got small charities where annual revenue is less than $250,000. There are medium charities between $250,000 and $1 million, and large charities where annual revenue is above the $1 million. We also know that there are similar rules in the not-for-profit space for associations in the various states. But I'm just looking at the ACNC requirements at this stage. Now, if you've got a small charity you've got an option to submit a financial report with the ACNC. That report can be special purpose or general purpose. You can actually choose cash or accrual accounting. If you do special purpose financial statements, there's no requirement for review or an audit. If you fall in that medium charity bucket, you must submit a financial report. It can be special purpose or general purpose, and it could be either reviewed or audited, but some form of assurance. And then if you look at a large charity, they must submit a financial report, special purpose or general purpose, and this has to be audited, needs to be audited. So just a little bit of an overview of, again, the current landscape. And now the other interesting thing, how does that landscape link to financial reporting? I got this from the ACNC website where they say, you know, if you've got a requirement that you must submit with the ACNC, so that's for medium and large charities, you have to you can submit special purpose or general purpose, but if you submit special purpose, you must apply as a minimum the following 6 accounting standards. All right, so an absolute minimum. And then they're also saying that recent amendments, and we're going to talk about that today, to AASB Standard 2020-2 do not affect or do not currently affect a charity's ability to prepare and submit special purpose financial reports. And the AASB's amendments only prevent some for-profit entities from preparing and submitting special purpose financial statements. And then you've got all the regulation there. So it's just that for not-for-profit entities, the project with the AASB, the ACNC, the various regulators is an ongoing project. I'm actually part of that project advisory panel at the AASB, you know, and, you know, time will tell where that's going to end up. So really what we're talking about today is we're mainly focusing on for-profit entities. So we've started with a current state as background. And we want to move to the future state. And as I said, it's mainly for for-profit entities. There are some small changes for not-for-profits around additional disclosures in the interim while the ongoing project is going on. But in the main, we're talking about for-profits. However, if you're a not-for-profit entity, you might still find this really interesting because surely, you know, this would kind of set a precedence on where we expect not-for-profits to end up in a number of years' time. So if we look at the future of special purpose financial statements, you would remember that right at the start I said the first decision an entity has to make in Australia is to consider whether the entity is a reporting entity or not. And there's a specific accounting standard, SAC 1, that deals with that. Now, for for-profit entities, that's no longer the case, or very soon that would no longer be the case, because the threshold question, that very first question, will actually be, is the entity required to prepare financial statements in accordance with Australian accounting standards? So we no longer have the reporting entity concept. It is your entity, doesn't matter, your entity, are you required to prepare financial statements in accordance with Australian accounting standards? And if you say yes, doesn't matter who requires it, but if you are required to prepare financials in accordance with Australian accounting standards, you have to prepare general purpose financial statements. It's the only way you can prepare financials in accordance with Australian accounting standards. Now, if not, then you have a choice whether you want to prepare general purpose financial statements voluntarily, or you want to do special purpose financial statements. Because in that bucket, you're not required by legislation, by trust deed, by constitution, by Corps Act, by ACNC, etc., to comply with Australian accounting standards, so you've got some choice there. Important to note, the mandatory effective date is years beginning on or after 1 July next year. That's just 6 months away. So that would mean if you've got a 30 June year end, 30 June 2022, or 31 December year end, 31 December 2022. Now, this is mandatory effective date, and I want to say upfront, if you want to make use of the benefits that are provided within transitional relief, you have to adopt the new standards before 1 July 2021. So actually, that would be 30 June 2020 next year, or at the very latest 31 December 2020. Sorry, it would be 30 June 2021 next year, or 31 December 2021 next year. All right, so that's close. That's really close. If you miss that, you don't get transitional relief. I can't say that and reiterate that enough. If you're thinking about a letter, which legislation, etc., would currently require us to comply with Australian accounting standards. It could be, or I'll show you soon, in the Corporations Act, we've got that requirement. The ATO has introduced that requirements for significant global entities. Another example is if you've got crowdfunding and you've raised more than $3 million cumulatively, you have to prepare financial statements in accordance with Australian accounting standards. So the whole idea is for the Australian Accounting Standards Board to set accounting standards, and for the various regulators to decide whether they want to mandate compliance with Australian accounting standards or not. So it's up to banks, it's up to those who draft legislation, it's up to regulators to make that decision, not the decision of the AASB. The AASB come up with the accounting standards, and these other people say, if we want people to give us financial statements, what do we want them to comply with? All right. So it's driven by that. Now, if we start with the Corps Act, to give you an example, it's maybe just highlighting complexity, Kevin. I mean, it's unreal if we look at the complexity we're dealing with here. If you look at the Corporations Act in section 296, it says the financial report for a financial year must comply with the accounting standards. And then when I clicked on accounting standards, and I went to the definition, it says an instrument in force under section 334 of the Corps Act. And then I went to that, I saw the bottom extract, that is, the AASB, the AASB's power is to make accounting standards. So if the AASB have made an accounting standard, that is what the Corps Act would like us to comply with. All the Australian accounting standards as made by the AASB. So, it's a very long-winded way to say if you are preparing and lodging financial statements with ASIC, you have to comply with Australian accounting standards. And therefore, going forward, if you prepare and if you lodge financial statements with ASIC, you will have to prepare and lodge general purpose financial statements with ASIC. It's a big shift because research have indicated, it's research that AASB have conducted with some external partners a number of years ago now, indicated that a very large percentage, and it was way more than 50% of entities that currently lodge with ASIC actually lodge special purpose financials. So this is a huge change. And then the other question that we often get asked is, what if our old documents, so our old constitution or our old trust deed or the one that's currently in place, requires compliance with Australian accounting standards? Now, this is an interesting one. It could be that we've previously referred to compliance with Australian accounting standards, not intending that to mean general purpose financial statements. And maybe for many years, these users were happy with special purpose financial statements. You know, how can we get some transitional relief in this space? And therefore, the change has been, you know, if your trust, your partnership, or another document requires compliance with Australian accounting standards, you'll only require to prepare general purpose financial statements if that trust deed, partnership agreement, other document was created or amended for whatever reason after 1 July 2021. You know, so as soon as that happens, you have to prepare general purpose financial statements for periods on or after 1 July 2021. So really what it's saying, now that you know about these new requirements, now that you know what compliance with Australian accounting standards mean, that it would mean general purpose financial statements, and if you still decide to write it into these documents, you cannot avoid the consequences. And I think the other thing I should highlight, please remember then that when we talk about general purpose financial statements, I'm talking about a broad collective name that could be Tier 1 general purpose or Tier 2 general purpose financial statements. That's a later decision. So if you look at, you know, the future of these special purpose financial statements and just thinking about, you know, this future state, you know, I want to raise some concerns up front and then we'll unpack them a bit during the webinar today. And that is, if you are currently lodging special purpose financial statements with ASIC, you need to think whether you're currently complying with all the recognition and measurement requirements of all Australian accounting standards, because that will impact your transition journey in future. I know it's ASIC's preference, articulated in their regulatory guide. It's BDO's preference, and we support that if you lodge with ASIC currently, you have to comply with the recognition and measurement requirements of the Australian accounting standards. But there were alternative views out there, and indeed some entities are currently preparing and lodging special purpose financial statements with ASIC where they're not doing all the recognition and measurement. And then the next question is, it's somewhat linked to that. We know that to date, ASIC has allowed entities to lodge parent entities' special purpose financial statements with them, and because the thinking has been that consolidation is a disclosure standard and disclosure standards are not mandated when you, or not even preferred or encouraged under the general rule that we want you to comply with all recognition and measurement requirements. Now that has been removed. Going forward, if you prepare general purpose financial statements, so if you're lodging financials with ASIC, it will have to be general purpose financial statements, and general purpose financial statements include consolidation if that is appropriate. So if you look at AASB 10, and if you control another entity and you have to consolidate under AASB 10, there's no way to avoid it. So those are some triggers, things to think about. The other thing is, if you're currently preparing special purpose financial statements, not just for ASIC, but for other users, is to double check, you know, what are the requirements of your trustee association, your bank. Are they requiring compliance with Australian accounting standards? And going forward, as these documents are updated, amended, for whatever reason, if it refers to Australian accounting standards, it would mean general purpose financial statements. So it's a real renewed emphasis on what we have in our trust deed, our constitution, and other documents. So if we transition from special purpose financial statements to general purpose financial statements, those transitional requirements are outlined in AASB 2020-2. And detailed rules here. You know, Kevin and I have debated this at length. We really think that our clients, entities in Australia, will have to be really careful over the next few years on how they transition and making the best commercial decisions. Kevin and I don't know if you want to maybe expand
Yeah,
on
I
this.
actually have.
I know we've discussed it quite a bit.
I have actually two examples ready to go for this, so I'm glad you brought it up at this point in the presentation. Interestingly, both of two recent new clients to the firm approached us to do what we called an IFRS health check, which is a very high level assessment of really how healthy are your financial statements. Are you really there yet? And it essentially, what it is doing is it runs you through your financials, your policies, whether they're consistent with IFRS. It does do an assessment of some of your competitors to see how the rest of the industry is doing it. But more importantly, it does an assessment to see whether you are ready to transition from special purpose to general purpose. So the health check that is intended for entities that have to do this transition in the next couple of years. And the two clients actually that approached us already claimed recognition and measurement compliance with IFRS. It was just a disclosure that they didn't have, and therefore they were just doing special purpose disclosure. So in theory, there shouldn't have been a problem. But we ran the health check anyhow, and the results were amazing. In one of the two, we found a material error lurking in the financials, which hadn't been noticed for 3 years, which by itself would have required an IFRS, a restatement of the results on transition. But we also ran into some really interesting concepts, things like missing accounting for some consolidated subsidiaries, which were just out there and never considered. Joint venture on a proportionate consolidation basis, which has been dead for years in some instances. And the list is endless. And one of the big issues that we actually discovered in both entities, that their functional reporting currency and their presentation reporting currency for foreign transactions didn't line up, to the degree that they literally were reporting in the wrong functional currency, which is a critical underlying error in accounting systems. They had to literally repost their entire accounting software entries for the last 3 years to bring them back up to the right answer before they could actually claim general purpose. The reason why those guys had put such effort into it is they're trying to list. And so they're jumping from special purpose to general purpose, full disclosure for purposes of a public offering document. Point I'm trying to make is this: get ready for this, but get yourself into a mindset of what's about to happen here, because transitioning from general purpose through AASB 1 essentially is a health check on the most recently issued prior financials opening balance, at least that far back. And then you literally have to navigate through all your recognition and measurement. And the assumption that you are compliant probably needs to be challenged before you enter into this project. And then once you find out what needs to be adjusted, there is essentially a prior period adjustment. It's not an error, it's an adjustment to get your comparatives restated up into IFRS, and there are a number of practical experience available to you at that point to deal with some of the problems, such as consolidation and so forth. This then, in terms of adopting recognition and measurement, when you're transitioning from special purpose to general purpose, the relief, as Aletta said earlier in the presentation, if you do have relief in terms of this process, you can only take it in the remaining year that's left before mandatory application. So looking at this diagram, which let us put on screen, the entity, if we had to use the two examples I put in front of you, assume 30 June 2020 is passed, they only have 30 June 2021 to use as an elective transition year, and they were allowed to then use things like relief from comparative presentation for the error that was identified. So you do the restatement of the error, but you don't have to necessarily present all the disclosures about the error. And of course, there are other comparative presentation reliefs in that 2021 year, such as related parties seems to be a big one, where you have to now make disclosures for related party, and you don't have comparative information about your related party transactions. You can take an exemption on the comparative year, but if you leave your adoption to the next year, which is 2022, you don't have those exemptions on the comparative presentation and disclosure, And if you don't have the information, well, that will be a scoping problem for signing off your financials materially compliant. So that's just 2 horror stories, 2 out of 2, which were horror stories just on entities that wanted a bit of a health check in the last couple of months.
Thank you very much, Kevin. I knew you had those stories up your sleeve. Thank you for sharing that with us. So on this slide, I've also put on the 31 December year end. So for 31 December 2020, you could already transition, but the very last year to transition with all the relief available would be 31 December 2021. And as you've said, for 30 June year ends, we've got one opportunity left, and that is 30 June next year. It's amazing how quickly times run out on this, getting ready for this transition. And then I wanted to ask, maybe stand back and think about this a bit more, and that is, are you ready for the preparation of general purpose financials? What am I thinking about? If we look at AASB 1, there's first time adoption of Australian accounting standards. So if you go from special purpose to general purpose, you have to do a AASB 1 adoption, because you're potentially going from whatever you've done in special purpose, and it can be a lot of different things, to general purpose. So are you across what AASB 1 requires? And then if you look at recognition and measurement requirements of all Australian accounting standards, a lot of people that's prepared special purpose in the past maybe not complied with all recognition and measurement, are not maybe 100% aware of what those accounting policy choices are, what the practical experience are. And this is why we've scheduled those webinars for early next year, to holistically look at all the Australian accounting standards and just focus on all the places that you've got choices available. And have you made the right choice for your organization, fit for purpose, best commercial outcome? And then another one that we're going to spend a bit of time on today is the new disclosure requirements in AASB 1060. Because as I've said earlier, previously, if you've done general purpose tier 2, you did reduce disclosure requirements. That's been removed, and it's now disclosure requirements outlined in AASB 1060. And that AASB 1060 consists of 92 pages of disclosure requirements. 244 paragraphs of disclosure requirements. I've actually broken them down and came up with 775 specific disclosure requirements. So, are you ready for that? And then consolidated financials. So even if you've done all the recognition and measurement of all the accounting standards, but you haven't consolidated, that's another big jump, huge jump. So are you ready for that? So what we've done, in addition to our monthly complimentary webinars that we would love you to join next year, and we're also rolling out virtual workshops where we're doing practical case studies. And it's all about getting ready for general purpose financial statements, looking at them standard by standard on, if you're doing special purpose or whatever you're doing, what does general purpose mean for that particular topic? So you can also look at that on our website. We've got an IFRS training hub that has some complementary stuff like the webinars, but there are also these virtual workshops, very much case studies. So that's the first part, the end of the road for special purpose financials. Now, this is such a complicated road because at the same time we're going from special purpose to general purpose. We also getting rid of reduced disclosure requirements. So many Australian entities, over the years have decided that they're going to go to general purpose, do RDR. In a way, a lot of people who were previously doing special purpose were encouraged to go to general purpose and do RDR, even if it wasn't mandated, but they were encouraged to do that. And now that regime is being removed and replaced with something else. So there's another big transition for those entities as well. And this removal of RDR is facilitated through the introduction of a new accounting standard, AASB 1060. Now, it's got a mandatory effective date exactly the same as the mandatory effective date for entities moving from special purpose to general purpose. So it's for years beginning on or after 1 July 2021. So remember, this AASB 1060 will be applied widespread in Australia, because a lot of entities currently doing special purpose are now going to do general purpose. And when they go to general purpose, they might not be publicly accountable, don't want to do tier 1. So we've got a large population of entities going from special purpose to general purpose tier 2. And that general purpose tier 2 is now changing from reduced disclosure requirements to the requirements in AASB 1060, the simplified disclosure requirements. So it's just really important to be aware of this, and that AASB 1060 is going to be a really important standard going forward. Maybe just to come back to where we've started the day, previous requirements, we had this reporting entity, non-reporting entity. And if you're a reporting entity, there was a tier 1 and a tier 2. So this tier 1 that I'm pointing to, this tier 2 that I'm pointing to used to be reduced disclosure requirements. So that's changing. Everything here around non-reporting entity are potentially moving to tier 2 as well. And therefore, this whole application of AASB 1060 is becoming really, really broad. So I just wanted to articulate that in a slightly different way. So it is important to note, if you ask the question, are special purpose financials being removed for all entities? No, it's not for all entities. If you do special, if you are not required to prepare financial statements in accordance with Australian accounting standards by your constitution or by legislation, you can still do special purpose, but we expect this population to reduce significantly. Then the other thing is, I try to maybe just look at it slightly differently. If you've got a for-profit private sector entity, which of them would be impacted? So obviously, if you look at your legislation, for example, Part 2M of the Corps Act, large proprietary companies, unlisted public companies, small proprietary companies controlled by a foreign company, AFSL licensees, small proprietary companies with crowdsourced funding, all of them impacted. Also impacted if your constitution or other documents are created or amended, after 1 July 2021, as we discussed earlier. So maybe, for-profit private sector entities who are not impacted. So entities that are not required by legislation to prepare financial statements in accordance with Australian accounting standards. And then entities where there's only a non-legislative requirement to prepare financial statements to complying with Australian accounting standards. And again, it's only a small situation. As soon as you change this, or you amend it, or you create it after 1 July 2021, you capture it again. So I think this is like short-term measure, really, if you look at it. So if you look at, the introduction of AASB 1060, if we've got an entity preparing general purpose financials and they tier 1, they apply all applicable accounting standards and all disclosures. That's the green bit. If you've got an entity preparing general purpose financial statements and they're in tier 2, and we're going to see the majority of entities, organizations in this category, they'll have to apply recognition and measurement requirements, which includes consolidation, under all accounting standards, but there are some disclosure relief applicable. And really how it works is you will not look at the disclosure requirements in all the accounting standards. Instead, you would ignore that and you'll only comply with the disclosures listed in AASB 1060. And that's why it's 92 pages long, because it's got the disclosure requirements for each and every Australian accounting standard that would be applicable to Tier 2. And then obviously, we have entities that still continue to prepare special purpose financial statements. And then all the, I would say, the uncertainty remains in that space. You know, exactly what do we comply with? For example, the ACNC would say you can do special purpose and you have to apply with 6 standards as a minimum, etc. But we're expecting the majority of the population to sit in this blue box. So it's important, you know, there's no change on Tier 1, there's no change on those that survive special purpose financial statements. The big change is for general purpose Tier 2 because RDR is being withdrawn. So a few frequently asked questions. People look at a presentation and they say, what's going on? One question, will all entities currently preparing special purpose financial statements be required to prepare full Tier 1 general purpose financial statements in the future? So all entities currently doing special purpose? And the answer is no. Only if you've got public accountability do you have to go to Tier 1. All right, so the fact that you're doing general purpose financial statements doesn't mean it has to be Tier 1. If we, let me, question 1. Question 2, do entities preparing Tier 2 general purpose financial statements need to apply consolidation and equity accounting? So general purpose financial statements, Tier 2, simplified disclosures. Do you have to consolidate? Absolutely. No way. No way you can get away from this. All right. Consolidation is in. It's here. It's here to stay. If we look at question 3, what are the main differences between RDR and simplified disclosures? Now, simplified disclosures are based on the disclosures in the IFRS for SMEs. So we're not picking up the recognition and measurement of the IFRS for SMEs. It's just based on the disclosures. It's not exactly the same as the disclosures, but it's based on it. It was just guiding the development by the AASB. The simplified disclosures are now in a separate disclosure standard for Tier 2 entities in Australia, so AASB 1060. And it would the framework will be referred to as Australian Accounting Standards Simplified Disclosures, where currently we would have had Australian Accounting Standards reduced RDR, reduced disclosure requirements. Must not-for-profits and for-profit public sector entities also apply the simplified disclosures? So this is a important thing for not-for-profits. So not-for-profits, although you can still do special purpose, but if you have elected in the past or you elect in future to do general purpose, which many not-for-profits do, and maybe in the past these not-for-profits used RDR, what about them? All right, so they also have to move to simplified disclosures. I think this is a practical thing from the AASB perspective. The AASB cannot retain and continue to update RDR for not-for-profits and also do simplified disclosures for for-profit. So simplified disclosures is what we have to look at. And then question 5, if a not-for-profit prepares special purpose financials, does it need to disclose the extent of compliance with Australian accounting standards? So this is really important, and this is a change for not-for-profits, and it's maybe a reminder because it came in this year already. So, if a not-for-profit prepares special purpose financials, no problem. You have to comply with the minimum 6, but also clearly articulate and disclose which accounting standards and what recognition and measurement of the accounting standards are you indeed complying with, to make sure that users know that. And I've put in some additional information here on what those disclosures would look like, what the relevant extracts from the standard are, and there's actually an example disclosure to make sure that you clearly articulate what you've done, so users got appropriate information. So the next section I want to get to is transitional relief. I'm going to say again, if you are not going to early adopt AASB 1060, if you're not going to early adopt general purpose financial statements, you know, if you're not going to do that, I want you to think again. Please think again, because this transitional relief would therefore not be available to you. Now, if you think about transitional leave, I've put this together just in my head to order my thinking. And to me, it is organizations have to think, how are you currently preparing financial statements? And then you have to think, how are you required to prepare financial statements in future? So this is mandatory requirements. And remember that future, we said if you've got a 30 June year end is 30 June 2022, that's in 18 months time. And then lastly, you have to think, what is the most appropriate transitional approach? And the one approach is to wait the 18 months and deal with the consequences. The other approach is to go early, 30 June next year, and use the transitional relief. So let's just get that clear. So, entities that's previously applied all the recognition and measurement standards, including consolidation, that's important. You can decide what transitional relief to apply, and you prepare your financials. And in that situation, because you've already done all the recognition, the measurement, the consolidation, it shouldn't be too big a deal. However, for the entities here in red that did not previously apply all the recognition and measurement standards, if you transition to the recognition and measurement of all Australian accounting standards, you have to consider whether you are allowed to apply AASB 1 or whether you have to apply AASB 108. That's looking at prior period errors, changing in accounting policies, etc. And then consider the transitional relief and the path you want to follow. You can see the bottom one is the harder one. And it's more important for these entities to really think carefully about transitional relief. The kind of relief that is potentially available, there's relief from distinguishing between the correction of errors and changes in accounting policy. And this is available for certain entities that adopt AASB 1060 before 1 July 2022. And there's also relief from presenting comparative information that's not previously disclosed, and again, before 1 July 2021. And I'm just looking at my first block, it should be before 1 July 2021 as well. And then we're looking at the third block on the right-hand side, relief from restating comparative information available for certain entities that adopt AASB 1060 before 1 July 2021. Please correct this. All three of those dates, it's about before 1 July 2021. Now, we've also put together this decision tree, and the purpose of this, I don't want to step through it all. I wanted to try and articulate to you the absolute complexity we're dealing with, and that it's not easy to decide on the best way. Because if you're a for-profit entity transitioning to Tier 2 simplified disclosures and you've previously done special purpose, it could be that you've done recognition and measurement and consolidation, that's the yellow bit, and then there's further decisions for you there. Or it could be on the right-hand side, the blue bit, that you've not applied all the recognition and measurement. And then if you look at it, it could be that you adopt AASB 1060 before 1 July, so you apply AASB 1. Or it could be on the right-hand side, the red, you adopt AASB 1060 after 1 July 2021. And, you know, you possibly have to go with AASB 108 and no transitional relief. But there are so many dates in here, so many options, so many choices. And you have to understand what all this relief really means for your organization. There's not a one answer here, because each and every entity has got a different starting point. We're all moving to the same endpoint, general purpose financials, simplified disclosures, but we come from so many different starting points. So really a call out to please think about this. If we just maybe look at, oh dear, I've lost my PowerPoint. I apologize for that. What's happened? I've closed. Just a second. I'll be back very quickly. I do apologize for that. I don't know. PowerPoint just closed on me. That's good fun. Last webinar for the year. We do need a bit of technological issues to end the year on a good note. It's opening up again. It's taking its time. All right, where was I? I think it was around 66. Yeah, there. Let me just share it again. Continue. Kevin, everybody back? You can see that? Slides back, Kevin?
Yes.
Kevin, yeah, okay, fantastic. All right, so, you know, if we just, you know, unpack that big slide a little bit, you know, if you've previously prepared special purpose financials and you've done all the recognition and measurement, we're looking at that yellow bit. You know, if you've adopted 1060 before 1 July, you've got new disclosure relief. If you adopted after 1 July, you know, you've got no transitional relief. We don't want to be in that bucket. If we look on the right-hand side of that diagram, there's so many options here. And this is particularly problematic if you haven't done all the recognition and measurement requirements in the past. And really, we've tried to articulate here the steps you have to go through. You know, you have to select the accounting policies that you have to use. So, you know, the accounting policies you select must either be the accounting standards currently effective, or the new Australian accounting standards if early adoption is permitted. In step 2, you have to recognize/de-recognize assets and liabilities. To make sure that you comply with these new Australian accounting standards. There is some transitional relief. You have to reclassify some items from the old framework to the new framework. You have to apply this new AASB to measure all these assets and liabilities in the new period and going forward. And then you need reconciliations. You must prepare reconciliations of equity and profit and loss from the last period in your most recent financials, prepared under special purpose, to that you're now going to do under Australian accounting standards. So we've got quite a lot of reconciliations to be prepared. There are some, you know, mandatory exceptions where AASB 1 prohibits retrospective application. So I'm asking the question again, are you across the requirements of AASB 1? So, you know, the mandatory acceptance where AASB 1 prohibits this retrospective application, estimates, de-recognition of financial assets and liability, hedge accounting, and non-controlling interests. And there are also optional exemptions that exist for certain transactions or balances. And now this is a wonderful list of optional things. Now, as soon as I see optionality, if I see choice, if I see accounting policy choices, if I see practical expedience, I think, okay, this is an opportunity for us to plan and to look at alternatives and look at best commercial outcomes. So I'm not going to work through all of them, but just look at the number of options available. And that is if you qualify to apply AASB 1 and you're not forced down a AASB 108 route. So, that's maybe just the significance there. Now, if you transition using AASB 108, because you may be leaving it a bit later, again, you have to go through this process. So a very similar process, but you don't have all that possible exemptions to consider. So that is a little bit of an overview, and I know it's really scary. The one thing that we have done at BDO is we've looked at this, and we know AASB 1060, 92 pages. I've unpacked it into 775 disclosure requirements, is coming. I have already had clients ask for 1 December 2020. They want to adopt it. Can we help? Definitely, if you want to use this transitional relief, you want to look at this for 30 June next year. And therefore, the problem here is we've got 775 disclosure requirements. And, how do you work through that and pick the appropriate ones? The other thing is, how do you provide evidence to your auditors that you've considered all 775 disclosure requirements and you've addressed the relevant ones? So how can we prepare AASB 1060 compliant financial statements effectively, efficiently? And I think there's two things here. There are two risks. If you look at this problem, the one risk is the time and the effort and the cost involved. The other risk is that risk of human error. Have we appropriately selected the appropriate disclosure requirements? And then our auditor friends will have a look at that. So from our perspective, I think to address the risk of time and cost and effort, I think technology is the answer. And the other one is to address the risk of human error. Technology is the answer. So what we've developed is a situation where you have a number of tailoring or scoping questions that will then pick the relevant 775 disclosure requirements that you have to comply with. So it's tailoring questions that would bring that population down to a more manageable number. And then also a report is generated afterwards that says, listen, Mr. Auditor or Mrs. Auditor or Miss Auditor, this is how we've answered the scoping question. So the auditor can have a look whether they agree with how you've answered the scoping questions. And then also, it then created all these relevant disclosures for us, maybe 100, 150 of them. How have we responded to those? And then, so here are our financials. This is how we've ensured that we've complied with the relevant disclosures. The auditor can then assess that and audit that. Now, it is at this stage that I would like to show a demonstration of this. So I'll quickly go to opening it up. And Kevin, you'll have to help me to make sure that you can see the right things. You'll see what I'm opening up is our technology solution. We're using the 6 Clicks platform, and you will remember 6 Clicks is also what we've previously used when we did our financial reporting risk review, where we looked at the differences between boards and finance teams. Now, this is a very short demo that I've done for you and set up. So we would send you this link, you open it up, and here you've got it. And what you've got here in the first instance are your framing or your scoping questions. And I've just got, to keep it short, I've got 3 framing or scoping questions. And for the first one, has the entity departed from a requirement in Australian accounting standards? I've answered yes. Has the entity in the second question presented financial statements for a period that is longer or shorter than 1 year for whatever reason? I've said yes. And then in the third question, has the entity changed the presentation or classification of items in the financial statements from the prior period? And you'll see for this one, we've put some guidance in there because we thought you might need some additional information, and I've said yes. So for my 3 scoping questions, if we imagine there were only 3 scoping questions, I've said yes to all 3 of them. And if I then go to the next page, I now get my disclosure requirements. And if you look here, you'll see I've got 12 disclosure requirements that I now have to deal with. And I'll now answer whether I've done it, and I can upload a document to support it. I could say I haven't done it because it's not material, etc. And I then get a report at the end on how I've answered the scoping questions, but also how I've answered or complied with the disclosures. However, I just want to show you the logic here. If we go back to the previous page, and let's say on the third question, we said, hang on, we have not changed our presentation or classification of items in the financials, right? Scoping question. If I now go to the next page, there's only 7 questions. So 12 disclosures drop down to 7 disclosures by answering no to that question. If I go back to the previous page, if I revisit scoping question 2 and I say, has the entity presented financial statements for a period that's not 1 year, shorter or longer? And if I say no, and I say, okay, what is the impact of this on my disclosure checklist? Now we only have 4 disclosures that we have to deal with. So 12 came down to 4. Now, if you go back to your very first question, just to push this through, and let's say we say no to all 3 scoping questions. Now, I appreciate that this will not be the case if you prepare financials. There will be more scoping questions. You won't say no to all of them, but in my little demo, if I said no to all 3, there would be no disclosures. So you can see how the scoping questions is creating an audit trail for our auditor, but also creates a way to move through 775 disclosures and come back to an appropriate, these are the relevant disclosures that you need. So at this stage, I thought I'll just get a bit of a sense on, would you use a technology technology solution in order to get to compliance with AASB 1060? Interested in your views. I'll give you a little bit to think and vote. Is technology to manage AASB 1060 something that you would embrace? Or would you work through the standard and deal with the disclosures in that way? I do appreciate you taking the time to respond. And also, we're nearly done, and then I'm going to share a video with you that one of our partners, Maria Jockel, has recorded on the pitfalls around migration. I know there's such a focus on Australia and employing Australians and Australia first, but some entities still need to bring in certain skilled workforce. So, what does that mean? If there's anybody who still wanted to put in their thinking, please do so. I'll close it very soon. At this stage, nearly 50% of our participants have actually expressed their thoughts. We really appreciate that. Thank you very much. I'll share what we found. there you can see, 13% very likely, 43% likely, 30% neutral, 12% unlikely, and 2% very unlikely. So very interesting. And then the other thing I thought, Kevin, it might be interesting to see, do you plan to early adopt AASB 1060?
Yeah, I've had, as I said, some experience here, and there's a cautious approach to this decision, which is really interesting because some of the other new accounting standards we had previously, which were big changes like leasing, some entities rushed to early adopt. They didn't think about the alternative transitional methods. They just jumped straight in. Whereas 1060 just seems to be one of those that everybody's really concerned about, and so it's this very slow assessment. And I think it's because there are reliefs in the non-mandatory adoption years, but there certainly is a tiptoe approach going on.
Yeah, Kevin, it's really interesting. I would have thought with some of the other standards, AASB 15 or 16 maybe would have only adopted that later. And maybe this one, because there are these benefits associated of early adoption, maybe go early. But you and I are actually seeing the opposite, which is interesting.
Yeah.
But we've got another 6 months to go.
I also think that Sydney didn't get locked up in COVID like you guys did in Melbourne, and I really do think it has affected the psyche of new projects and just the will to live on some of these. So I think we're all coming out a really odd year.
It's been a really odd year, Kevin. But let's focus on 2021. I actually wanted to call Christmas a few months ago and say let's do Christmas and New Year and let's do 2021. But that's a Melbourne perspective. Again, thank you very much for everybody that's participated. I really appreciate you taking the time to share your thoughts with us. We'll share it with the broader group. So early adopting, there's quite a big percentage very likely, 31% likely, 39% still neutral, and then 70% unlikely. So interesting, I think an interesting conversation and interesting debate to have. It's the one we have to have, right? The discussion we need to have here. Then next, I would like to show you a short video, just 2 minutes, on what are the financial implications of getting migration or employment wrong. And I'll just do that. And now Aleda's trying something new, so please bear with me. I love change and new things, but it can be difficult at times. Kevin, can you see our video of Maria?
Aletta?
Yes, you have Maria on the screen at least, I'm hoping.
Hello, my name is Maria Jockel. I'm the legal principal for BDO Migration Services, an incorporated specialist immigration law firm. We provide comprehensive support on every aspect of migration law. We know that every organisation's biggest asset is their people, and getting the right people at the right time is critical for success. In fact, if you don't have the right human capital, which is a silent record on your balance sheet could suffer in the long term. We also know that businesses are trying to support our economic recovery and address unemployment issues by hiring Australians. The problem is that we have a significant skill shortage in particular areas, so we still have a crucial need for skilled migration. While the borders are selectively open to particular occupations, like the health and cyber security industries, the process can be opaque, particularly at this time. The migration process is part of a complex system. It's costly, it's very document and information intensive, but the true cost of getting the process wrong could mean lengthy delays, or even worse, there could be significant financial implications for your business. So it's critical to get it right the first time. Our new webinar series, Working in Australia, launches in February 2021. Through the series, we'll discuss a range of migration, risk and compliance problems faced by employers in Australia. For example, in the first event, I'll be discussing the impact of COVID-19 on the management of Australia's borders. While the topic of migration or employment might seem like it sits with your counterparts in human resources, the implications of getting this wrong can have consequences on your business. So we'd love to have you join us, and if there is someone in your business or network who is facing employment or migration challenges, please feel free to invite them along also. We'll send details after the event, or you can simply visit bdo.com.au/events. We look forward to seeing you there, and thank you very much for listening.
Thank you very much. So that's really the end of our webinar. I would like to say thank you very much for all of you for your support during the year. And I'll just want to, let me just go back to our slides. Kevin, I just wanted to say on behalf of Kevin and I and our broader BDO IFRS advisory team, thank you very much for your support during the year, your patience, your encouragement, your kindness. It's been really lovely to do these webinars with you during the year. I've done 10 of these webinars from my home in Melbourne, and just the opportunity to work with Kevin and speak to all of you has been really encouraging and kept me sane. So we want to say thank you very much. We hope you're well. We hope you're healthy. We hope you get to spend some time with your families and that you're well rested. But we do hope that you join us again next year as we continue on our IFRS journey. If you need assistance around audit ready, people are getting ready for 30 June next year or even 31 December still, please feel free to contact us. Our audit ready services, our financial reporting health check, as Kevin explained, is available. I still get a lot of calls from clients around leases. It's just too painful. How can you help? It's painful. So just a reminder of the options we've got available. And Ashley will be joining us next year for these webinars. So you'll get 3 of the 4 IFRS partners on a monthly basis. And that's our broader team. So really from Kevin and I and the whole team, thank you very much. We hope 2021 is a wonderful year. And if you celebrate Christmas like me, Merry Christmas. Kevin, a final goodbye?
Goodbye for me, but a letter on behalf of everybody else on this webinar. Thank you for holding this together for the year. It is all up to you at the end of the day. You do a great job. So thank you on behalf of all of us, and everybody else. Have a Merry Christmas.
Thank you, Kevin. Goodbye, everybody.